Taimur Baig is now with us. He's Managing Director and Chief Economist at DBS Group Research. Taimur, thanks very much. US, the Nasdaq is up 20% from its April lows, Taimur. So there you have it. Consequential week, not this one, but the week before. And big recovery from the lows. What's the state of play with regards to sort of growth expectations out there with all this tariff talk and deals, etc., which are being spoken about? What's your sense, Taimur?
Decidedly poor. I'm not buying any of this rally or this expectation that things are going to work out. I just came back from Washington, D.C. after a week in the IMF World Bank meetings. And the feeling is that the discussion around trade is entirely political. It is not technical. It is not based on any analysis that can be seen at a level playing field by both the U.S. and their counterparties. And as a result, the signal for the markets would be very mixed and would be uncertain and volatile going forward. I met with people who have been privy to the discussion between the Japanese and the Americans, and I was told the discussion is entirely at a rather high level, political level, not the kind of discussion you want to have between trade representatives, technical discussion, specific tariffs, specific sector, legal aspects. None of those things are really on the table. And therefore, I think that the hope that the White House messaging, that a bunch of deals are on the table, we're going to see landmark announcements, and this will all go away, will be proven spectacularly wrong. And as a result, I think this relief rally that I'm seeing, to me, is more like a dead cat bounce than anything else.
Wow, that's quite something, Taimur. You've really made us sit at the edge of our seats and take notice, because that's very, very helpful perspective, given that you've been speaking to people in Washington. So from the market standpoint, and this is always the worry, right? First of all, will they get a deal or not? And even if they get a deal, okay, maybe it's not, say 145%, but even if it is 50%, or in India's case, even if it is, a couple of notches lower than 26, what does it really do? Let me go back to the main question. The market for now wants to look away from the recession and slowdown and inflation possibilities in the US. What do you think could be closer to the truth here?
I'm not particularly concerned about a major negative spiral as far as the U.S. economy is concerned. Let's also be, careful of characterizing the U.S. economy in the appropriate way. U.S. is a largely closed economy driven by domestic demand. The net exports contribution to growth usually is rather negligible. Now, what we saw in the first quarter data was an astonishing development where importers, rightly expecting huge amount of tariff, decided to front load a massive amount of their imports, and as a result, net exports contributed minus 5% to growth. If you correct for that, the U.S. economy actually had a pretty decent first quarter. Now, in the second quarter, we will see the opposite, which is exports will be okay, but imports would collapse, and as a result, whatever slightly negative number we saw in the first quarter would be given back, and we'll get, for the first half of 2025, something in the range of 1.5–2% growth. So I don't think the U.S. economy is about to crater. The market's expectation that a huge number of rate cuts are just around the corner because of a tariff-induced recession, I think would be proven wrong. The risk is on the inflation side. Regardless of where tariffs go, U.S. producers are clear in their signaling. They will raise prices. They are raising prices. We see survey after survey around that. And that would certainly make it very, very difficult for the Fed to provide accommodation to the monetary policy stance, which is what the White House is demanding. For me, as a result of these sort of expectation, I would be a pair of U.S. rates, not a receiver. And I would also expect that the U.S. dollar not to continue its downward move, but actually stabilize, because inflation expectations would feed into interest rate expectation, would then feed into people saying dollars selling is overdone, and we might go long the dollar.
All right. Hi, Taimur. Good morning. And in fact, good to see you. And Nigel on this side. The last time we chatted, you were hinting that maybe, in fact, the risk reward for a rupee could be, on the appreciation side. And it appears the rupee, after going closer to around 87, it's pulled back. What's the course you're seeing out here for the Indian rupee? And your brief take on the estimates that you're working with for the Indian economy.
Correct. And I will basically start with the cue that you guys were giving earlier, which is that the FII flows have finally turned positive. And that is, of course, a rupee positive development, and a massive easing of oil prices, of course, is fantastic news for oil importers like India. So I think the rupee is enjoying several sources of tailwind, both in the inflow side as well as in the current account side. This will continue. Again, we should not all conflate all developments around tariff. There are certain macroeconomic developments that are taking place, which is certainly positive. India, and also the realignment of supply chain, for what it's worth, should be positive, not negative. It may not be a massive positive, but the risk reward is on the positive side of the spectrum. So put it all together, a rupee smile, precisely when the dollar seems to be, not that much loved, is very much on the cards. Now, is there a substantial amount of additional upside to the rupee? Connecting what I said earlier, that if indeed U.S. interest rate expectations get a bit sticky, around that, we now actually don't expect any more of the compression of the yield differential, interest rate differential between U.S. dollar and EM currencies, then perhaps the rupee's moment in the sun can be, abating a bit going forward. We've had the big amount of rally already, maybe not much more left.
Very quickly, Taimur, when we say we talk about a deal, right? And India's been mentioned quite a bit. As an economist, what are you expecting? What kind of a deal when the document comes through? Will this be like a MOU? Will this be a framework kind of, okay, this is essentially what we will now agree upon. We will reduce here, you will reduce there. Not exacts, or are you expecting exacts, like a deal?
Absolutely not. I would paraphrase something that Donald Trump said during the election, that there will be a concept of a plan. There will be MOUs, there will be certain amount of promises made, but trade agreement, the kind of thing that EU and India has been trying to do for the last few years. That is a very long technical legal document. We're not going to see anything like that. We will see a bit like, the phase one deal that China and the US had signed during Trump 1.0. Certain promises to buy more, certain promises to sell less because, the trade balance has to improve, certain promises to buy less from China. That kind of stuff I would expect to see. A major trade deal, as we all know, requires technical people, multiple years, and those are legal documents, not something that politicians write down.
All right. MOUs, when we talk about companies and MOU for orders, etc., sometimes they translate into actual orders, sometimes they don't. But some kind of agreement essentially is what you're pointing to. Right. And I think that's fair enough. Thanks very much, Taimur. Appreciate you joining us, and it's a pleasure.